Hello, and welcome to the 16th episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So, as we all know, today is Thursday, always on Thursdays at 8 p.m. This is when we cover this content. So, let's start with mic test. So, if you can hear me clearly, like hi, the live mindset, and then this will tell me that everything is working just fine. So evening, Fred. Thank you. Thank you for your response. I think that's confirmation enough. So I'll start right away. So we know this has been quite busy week. Hi, Martin. Hi, David. Thank you, guys. Thank you for your responses. So among the key highlights for the week has been 3 decisions by 3 different central banks. And I think this is the area of most interest for a majority of our traders. So on one hand, we had the news yesterday affecting the US, and this was basically the federal funds rate for the US, which was hiked by 25 basis points, thereby bringing interest rates from 4.5% to 4.75% as expected. Then the second piece of news that we had, which happened earlier today, was the Bank of England basically voting to hike interest rates by 50 basis points. So this effectively moved interest rates from 3.5% to 4% as expected. Then later on in the evening, we had the news from the Eurozone. So the European Central Bank basically adjusted interest rates from 2.5% to 3%. And this was as expected with 25 basis points. So that's very important to know. And once we try and understand what's happening between these 3 economies, then perhaps we'll identify potential trading. So as we proceed with this presentation, we should know that it doesn't constitute what we call investment advice. So this is a pure educational. You should always do your own due diligence. So from the chart and what we are looking at here, this is the chart of the UK 100, or what we call the FTSE 100 index, which is basically used as the benchmark index for the UK stock market. So whenever it's going up, it's indicative that the overall UK stock market is healthy and doing well. And if it's going down, then we have the opposite. So as you can see, it has been quite bullish, especially since December. The better part of January, it was going up before it moved sideways in like a triangle, then eventually made a breakout 2 days ago. This was Tuesday, retested here yesterday before bouncing, and today seems to be pushing even higher. So this is along the same correlation with other indices. So if you look at the US Tech 100, strongly bullish this week as well as the last 4 weeks. So clearly we are seeing a period of time where a lot of stock markets are making a very strong recovery after having experienced a very strong bear market last year. So January was very good for equities, and now February has started strongly, and there's a good chance that we'll be seeing some further upside in this equity. However, when it comes to trading, we know that we focus both fundamental analysis as well as analysis. So we'll try to understand the fundamentals behind these and also try to identify the technical levels that might present opportunities for trading this year. So also a key highlight is gold, which happened to be strongly bullish yesterday. Then today reversed the momentum completely. In this case, indicating a strong dollar and so as for the dollar index, we had a very sharp drop yesterday. And this was as a result of the US interest rate news. Then today made a very strong recovery. So we are seeing a very strong dollar, basically erasing the losses that were experienced yesterday in the evening. So now, potentially, we could be seeing the dollar start to make quite a strong recovery and the opposite effect in equities. So while on one hand, we are seeing a very strong US stock market and also a very strong dollar index, it's not one of the features that we've been experiencing. For the better part of trading of last year, we had opposite correlation between them. So when the dollar was strengthening, the stock market was weakening. And whenever the dollar was weakening, then the stock market was strengthening. So let's try to establish a basis for what is happening right now. And once we understand this, then get back to the charts and understand what is happening here. So as we all know, if you have a suggestion of a market you'd like us to look into, you always type that, the live comment section. And at the same time, if you have any contribution to the discussion at hand, then you always type that in the live comment section. Hopefully make the session as interactive as possible. So I'm hoping that you guys made money in the news yesterday as well as today. If you didn't make money, there will be similar news next month. So you still have more time to prepare. So let's start with the economic calendar. So from the economic calendar, you can already see the news of yesterday. That is the FOMC statement as well as the federal funds rate. So for the federal funds rate, we know very well that the US has been consistently hiking interest rates since March last year. So a very strong pace of growth in the interest rates in the US has several outcomes in the economy. One key thing to notice is that whenever interest rates are hiked in the economy, that effect doesn't fully appear within the economy up until a period of around 12 months. So the full effect of the interest rates that happened, interest rate hike that happened in March last year will probably be felt in the US economy in March this year. So the rates that the Fed has been pressing on might be having a much bigger effect later this year. And this may explain the reaction that CEOs in the US are doing. In so doing, we have seen out of tech companies cut their jobs as well as freeze their hiring this year, with some of the highlights, including Microsoft cutting over 10,000 jobs, same case as Google, Alphabet, same case as Facebook, and so on. So these companies are acting in preparation of what they are seeing as the future of the US economy. And they're expecting that these very strong rate hikes that happened last year have a much bigger effect in the US. And if we try to summarize it, we know one thing: higher interest rates basically increase the cost of borrowing. So people find themselves paying much higher interest rates on their credit card debt, and they are left with less money to spend in the economy. At the same time, during this period, we're also experiencing very high inflation, which at some point peaked at 9.1%. Yes, it has been slowing down, but still at a level of 6.1%, the inflation is still very high. So we are expecting that whenever there is high inflation, the US consumer is spending more money on basic commodities. And we're talking about food, healthcare, transport, and all that, beverages. In so doing, then they are left with less money to invest and also less money to buy other products. So the overall effect of this is that looking into the future, the current quarter as well as the second quarter of this year, we will be expecting a much weaker US consumer. And in that case, companies in the US may not make as much sales as they were doing last year or the year before. So with this expectation, we expect the stock valuations of these companies to start weakening heading into quarter 2023, and perhaps even further weakness in quarter 3 and quarter 4. So this may explain why some of the top investment banks are expecting the US economy to get into a recession later this year, and they might be reacting to hard inflation. So one of the ways that these companies are reacting to the potential of a recession is by buying an asset that they feel might perform well in a high or in a recession environment. And this may explain one of the factors that is contributing to the strong run in gold since late year. So if you look at gold prices and you go to the forward chart, then you'll notice that there is a very strong bull run that started somewhere around November, and this has been persistently going up, basically indicating out of demand for this precious metal. So this has created some good opportunities. If you manage to buy anywhere between 16, 17 and the current price level, then you must have made some good cash, and we expect this trend to continue. So besides central banks being in a hurry to buy more and more gold for their reserves, we have seen it happen with the Federal Reserve Bank of the US, the Central Bank of Russia, the People's Bank of China, among many other central banks, are hurriedly buying more gold in the stock in the market. And this is more than a 55-year high. So in 55 years, we have never seen such an appetite of gold from central banks. And when you combine this information with the participation of investment banks and as well as other investors buying gold, then you know that this is in preparation of something bad that will happen. And most assuredly, there's a good chance that the US economy will be in a recession, as well as several European economies. And the result of this is the strong trend that we are seeing. So today, you can see there has been a very strong reversal here, as the market is reversing the effects of the FOMC press conference yesterday. And now this may potentially present an opportunity to go for another long position in gold, because longer term, we're expecting some higher prices. So it has been forming higher highs as well as higher lows. So should not be worried by the sharp spike here, because it's news. So news cause this kind of spikes, and it's quite normal. But then, if you are a technical trader, you know there's a very strong technical level around this area. And this is around 1970. So if you are to hold onto your trade patiently and then wait for the market to present an opportunity, there is a good chance that you'll be finding a long position in gold and trading higher upwards. However, if it remains persistently bearish now, then you might mark the previous around here. This is the 1900 price level. So a break here could potentially gold to 1900, and then perhaps some other upwards. So as for the major currency pairs, it's the same case for Euro USD, has been on a very strong bull run. And the main reason we are seeing this happening is because of the policy divergence that is seemingly getting wider and wider between the Federal Reserve Bank of the US and the European Central Bank. So a step back to last year or the last 2 years, then you notice that the dollar was very strong, whereas the euro was very weak against the dollar. At some point, we saw the euro trading below parity, or below 1 So you can see there's a period when the euro USD was trading below 1. If I mark the 1 price level, so for this region, the dollar was more affordable than euro before the reversal in the market started. So what we are seeing from the meetings that happened yesterday and today is, on one hand, the US is getting inflation in control, having peaked at 9.1%. And now, from the most recent reading in December, inflation had slowed down for the sixth consecutive month to 6.4%. However, for the Eurozone, inflation is still a big problem, having read 9.2% in December. So that is significantly higher than what we are seeing in the US. So conditions are not all that favorable for the Eurozone. So this is forcing the hand of the central bank, the European Union, or the European Central Bank, to basically get more aggressive with the rate hikes. And that's why today we saw 50 basis point hike. Whereas when you compare with what the Federal Reserve Bank is doing, it's basically slowing down the rate hikes, hoping that inflation will eventually get back to target of 2%. So the Fed was very aggressive last year, doing a sequence of 75 basis point hikes. Then in December, it slowed down to 50 basis points. And then now, in the reading in February, has slowed further down to 0.2%. So with this slowing down, we're expecting that eventually we'll get to the end of the rate hike cycle, and the Fed will be looking to cut interest rates, perhaps in the last quarter of this year. So with that expectation, when you compare the other policy in the European region, we know that the ECB hiked by 50 basis points and also promised to do some further hiking within this quarter in order to control the rising inflation. So this creates a very strong policy divergence that is creating the bull run in the Euro USD. So as long as there is more tightening, then the local currency gets stronger, whereas the local equities get weaker. So we might be seeing weaker European equities as well as a strong euro. And when you pair now the euro with the US dollar, then the overall expectation is that the pair keeps going up. So if you are a trend trader, then you might be interested in some technicals. So if you basically look at the low that we experienced here in October, compare with this other low that happened in December, and then there's another low that happened earlier this month, then you know that there is a pattern and an expectation that whenever the market gets close to this lower trend line, then it creates a value area where you can execute a strong bullish momentum trade. So in this case, as long as the market keeps pressing and pushing for the downwards, then the optimum or the best point to look for a buying position would be on this support level, which happens to lie on the lower trend line, somewhere around 108390. So this could be a potential entry point if we continue seeing the Euro USD lose to the dollar downwards. So similar case is happening with the pound USD. We know that during the news announcement, there was this kind of whipsaw, where immediately after the announcement of the news, there was a spike by 59 pips, and then an opposite direction movement of 113.3 pips. However, a longer term look at what has been happening with the pound, similar case, the Bank of England was not at all aggressive in hiking rates, whereas the Fed was very aggressive, doing 75 basis points from March, eventually ending the year with 50 basis points. So this created a very strong demand for the dollar, very strong bear market. We saw the pound bottoming at 103 to 16. Then after this, a very strong reversal. So from September, we saw a very strong reversal. The market kept going up, and now what we are seeing here is a potential top at 1.24475, and then a pullback that lasted about 4 weeks, then a push back to the same level, which happened to face a very strong resistance, similar to the previous resistance here. And now we are seeing the opposite reaction, market moving further back downwards. So the idea is, if the Bank of England remains aggressive in hiking interest rates, then we want to continue riding the bullish momentum. So the bullish momentum happens to be along a trend line that has broken. So now we might have to. So the green line here has already been broken. So if we continue having a strong bullish bias in this pair, then we might want other levels to determine an entry for some bullish momentum and perhaps break the 1.24475. So, however, on the contrary, if the US dollar happens to remain strong, then this particular movement continues. But if I was to remove this and then just highlight the overall movement for the last couple of days, I would say 10 days, then it would make sense to say that this market has not been moving up or down, it has largely been moving sideways. So this has been a ranging market. So if you are a technical trader and you have not been identifying good opportunities in currencies in the last 2 weeks, then this might explain why. So a lot of currencies have been moving sideways, ranging from one resistance to support. And now there seems to be some break here, but I would be looking for a potential back up where the pound would be regaining against the US dollar. So Audi USD has been one of the most aggressive currencies, or the biggest gainer in terms of currencies against the dollar. So having gained all these, then it becomes a currency of interest. So with a very strong audio USD, then you might want to look at the opportunities closely in order to identify what exists and get to trade along the trend. So clearly, as you can see, for the last 7 weeks, we have been seeing a very strong Australian dollar against US dollar, a sequence of higher highs and a sequence of higher lows. That particular pattern has not been broken yet. So now, as a result of the momentum, the news, we saw the market spike all the way up and then back down. So we could be seeing the market go further down here and then potentially another rally along the same trend, as long as the Australian dollar or the Reserve Bank of Australia continues being aggressive with interest rate hikes. So we know that the Reserve Bank of Australia has not been very aggressive. However, the current economic conditions in Australia are actually forcing the RBA to get aggressive. So as long as inflation remains strong, which was very strong as per the reading earlier this week, then this forces the RBA to be very aggressive. And I think investors are already betting on this. So the pattern remains. So it's all about identifying a value area, trade along the same direction. So as we proceed with the presentation, remember also checking to see if you have any questions. So just a moment, I want to check. Yes, there's a question from Charles Thierry. Question is about gold. We have already covered these. Contrast the NASDAQ SPX to Dow Jones. Yes. So I'll check that. Hello, Michael. Hello, Eric. And thank you, guys. So let's get to the last part of the presentation. And in this case, we look at the major indices and look at how they are performing. So I'll just do a quick check for the S&P 500. So I like using FinViz. It's a really good website when you are really interested in the S&P 500 and looking at the map. So the map gives you a heads up of what's happening in the market. So for instance, clearly, you can see that today has been a very good day for tech, communication, and consumer cyclicals. Real estate is also good. Financials are quite healthy, whereas the bloodbath in healthcare and energy is very clear to everyone, as well as the right. Apologies for that. Lost my connection for a moment. Now I'm back. Can you hear me now? All right. So now, what we are looking at here is the S&P 500 index, and we are trying to get the year-to-date performance. This is the performance since the beginning of the year. So while some good companies have really done well, like Tesla up 56%, Nvidia up 45%, some companies are still struggling to make some growth. For instance, Pfizer is down 14%, J&J down 7%, Lilly 12%, and so on. So it has been a good year so far for the past 1 month for stock market traders. we have seen a lot of bullish market momentum and also a very strong recovery. So among the hottest sectors, seems like the worst performing sectors of the last 2 years are now the best performing sector. So communication services was among the worst sectors last year. And now look at how it's making a very strong recovery. Consumer cyclicals, they are making a strong one. Tech was basically a bloodbath, and now we are seeing some good numbers. And this basically tells you the story of what's happening in the markets. There is a lot of optimism that the bear market has ended, and a lot of investors believe that the bull market is now here with us, and this explains the high demand and the push towards the upper side. So, though the fundamentals are not indicating the same, the activity from the market is indicating the same, and this explains why you have a very strong recovery here. So you have to be very careful looking forward. As long as these companies are revising their outlooks downwards, then it basically means that from the data they are not expecting to make as much growth as they did the last couple of years when we had a bull market. So we still have to practice some level of discretion in trying to determine whether this is the actual bottom or whether we'll be having another run downwards. So personally, I think this is not the bottom yet. We still have some more room to feel the effect of the high interest rates that were implemented last year. This would already mean further downside in equities. So I'm seeing some good comments. Thank you for the responses, guys. What should we expect if both the USD and pound rise together? So if both the pound and the US dollar are gaining together, then you have to look for a weak guy in the currencies. So you have to find another weak currency to pair with a strong currency. So you might want to look for one central bank that is not as aggressive tightening, and then pair that with what we are seeing. So one popular candidate right now would be the Canadian dollar. We saw the Bank of Canada last week mentioning that they are not looking to make any other rate hike. They are happy with the current rate hike. So they are willing to look at the data and wait for inflation to slow down as the rate hikes take other effect in the market. And in that case, we are not expecting the Bank of Canada to be getting aggressive. So this could be a potential target if you're looking to pair or to trade the divergence between central banks. So Canadian dollar could potentially become this year as a result of the central bank now becoming very dovish. So I hope I've answered your question, Alfred. So as a matter of correlation from your Euro USD and AUD USD analysis, shows the USD will be weak, but is it this against the intention of the Fed to have a strong dollar? So yes, there is what we expect, and then there is what the market is telling us. So from what the market is telling us is that the US dollar is regaining some strength here. But then look at this, look at the forward chart for the dollar index. So since the beginning of the year, we started with a spike upwards, then back down. The first week, second week, downwards momentum, third and fourth week almost sideways, and then the fifth week we are still below. So it's basically indicating a weak dollar, which is in correlation with what we are seeing in equities, a very strong S&P 500, a very strong Dow Jones, and also a very strong NASDAQ. So we are seeing this correlation playing just like last year. So what this means is that if overall we are expecting the dollar to strengthen as the Fed continues hiking interest rates, then the equities should be weakening. However, with the 25 basis points that we had yesterday, the market is pricing in just 25 basis point hike in the quarter, and then no more rate hikes in the US. So with this, remember what we always say, the market is always forward-looking. So you are not going to wait until your favorite stock is up 100% so that you can buy. So if your favorite stock is a Tesla, it's down 69% in a year, and then you realize that the Fed could potentially stop the rate hikes early this year, Then you buy when the prices are really low because you are forward looking. So in this case, it explains why we are having a strong bull run, as a lot of these stocks in the S&P 500 appeared to be very cheap in January this year. So that's why we are seeing this strong run. However, as I mentioned, I expect the bear market to continue, and a lot of investors will be focusing on the earnings that we see perhaps in the second quarter. So remember, the earnings that you are getting this week represent mostly the last 3 or 4 months last year. And now, as the high interest rates start taking effect in the US economy, companies will be taking a hit, their revenues, as well as their profits. And this will be reflected in the next cycle of earnings. And those earnings tell a different picture of the US economy. And that's potentially when we'll be seeing some further downside. So whereas these has broken the upper side, indicating some further bullish momentum, there's a good chance we'll be seeing some further upside. But then once we realize that the economy is still weak, then we start seeing the dollar weakening, the dollar strengthening, and the equities start to weaken. So that's my overall analysis for the US indices in relation to the US dollar. So as for now, it's a weak dollar, as you can see, and a weak dollar would make a strong case for a strong bullish momentum for USD, a strong bullish momentum for gold, and also a strong bullish momentum of USD among pairs such as the pound USD here. So I'll still be looking for a bullish case to trade these pairs, taking advantage of the much weaker dollar. So a good question here, is it a good idea trade crosses? It's not bad per se. I wouldn't say it's bad to trade crosses. What happens is that on one hand, you are trading a derivative product. If you're trading, let's say, a cross, such as, let's say, pound yen, that is a derivative of 2 currencies. So it's a derivative of pound USD and USD yen. So whenever you're trading pound yen, you have to be very aware of what's happening in the UK. That's you have to study the UK economy. You have to consider what's happening in Japan. So on top of that, you have to consider what is happening in the US. So now you're looking at 3 economies and trading just one pair. In that case, if you look at the 3 economies, let's say the UK and the Japanese economy and the US, then there's 2 potential pairs that you can trade. That would be USD JPY and the pound USD. But in this case, you choose to do pound yen, which means that you're doing more work. However, if you are just purely a technical trader, then there's absolutely nothing to that. So those are basically very simple concepts that we all need to understand. And of course, in terms of our cost analysis, we know that crosses have much higher spreads compared to the major currencies. So the cost of trading will be significantly higher if you choose to specialize on crosses. So that's it for today. I didn't have much. I just wanted to clarify on the aggressiveness of the 3 central banks that reported their interest rates this week. Now that you understand how those central banks are reacting, then you can easily find one central bank that is getting very aggressive versus one that is less aggressive, and then trade along the direction of that currency pair. So it was a very easy trade doing so last year, and it will still be a very easy trade doing the same thing this year. So last year, the biggest trade of the year for myself and for a lot more other traders there was USD JPY. So we knew that the Bank of Japan was beginning low interest rates. There was high quantitative easing. So we experienced a very strong run here where the US dollar was consistently gaining against the yen, since Fed was very aggressive and the Bank of Japan was not gaining aggressive. So it made an easy trade here. Of course, I didn't make one trade from here to here, but the in-between trades that I used to make intraday and intra-week they had a higher chance of winning because I understood the policy between the Bank of Japan and the Federal Reserve Bank of the US. So I already had one card up my sleeve. So it was easy to identify potential trades and keep on pushing this pair higher. So now that we understand some of the fundamentals, USD, pound USD, pound USD, then the other part is the side to work out your technical analysis, patterns and skills, and identify potential trading opportunities. So that's all for today. Gold seems to be extremely bearish here, but then I'll be still very patient, looking for a potential entry by buyers, then I'll trade the reversal. So thank you guys, and I hope to see you on the next session. Yes, I almost missed this. Thank you for asking this. Say something on oil and OPEC meeting. I think that's good. So the OPEC meeting did not have any surprises. The OPEC plus countries decided to maintain the same policy that they maintained in late last year. And this is cutting oil output by 2 million barrels per day. And this is expected to maintain the same supply in the market. So this leaves the fundamentals of trading oil towards the demand side. So remember, whenever you're analyzing the potential for the movement of oil, so you want to understand on one side the demand and the other side the supply. So now that we know that the supply remains the same, so if you look at demand, you look at the major consumers, especially China. So if China is vibrant, then demand is high and oil gets upwards pressure. However, if it's the exact opposite, and you see a weak China, a weak India, a weak US, a weak Eurozone, in that case, you trade the other way around. So now we have seen the price of oil hit a very important trend line that we began to see back in December. So remember when Biden started tapping the strategic oil reserve in the US in March last year, we saw a very strong pressure pushing all the way, oil all the way back down to $78. So oil was very high last year. Biden tapped the strategic oil reserve, oil pulled and went all the way back down. So now what we are seeing is a market that is now beginning to form higher lows and also higher highs. And according to this projection here, it seems like the current price level is very interesting and also a potential trading opportunity, since we can already see signs of buyers entering this market from this trend line. There are two confirmations of the trend line from the bottom here and also this bottom. So it seems like we have at that point here. So we could be seeing some further upside in this. And thank you for suggesting that we check this out. I almost forgot. So as for the distinction, I think we'll be doing that in the next session. That is the distinction between, I think it was the Dow, just check the contrast between the Dow Jones and the NASDAQ. So the thing is, the Dow Jones Industrial Average is majorly dominated by industrial companies. These are top blue chip companies that have been very resilient and their markets are quite consistent. They are not as volatile as the companies dominating the NASDAQ. So the NASDAQ 100 basically has some of the 100 top tech companies in the US, including Apple, Amazon, Meta platforms, and so on. So Amazon is NASDAQ is majorly used as a benchmark index to track how the tech sector is doing in the US, whereas the Dow Jones is used as a benchmark to test how manufacturing trends are doing in the US. So companies in the industrial sector basically serve manufacturing. So if manufacturing is doing well, then the Dow tends to benefit from that. So last year, the Dow outperformed the NASDAQ, since during the bear market, the tech sector was among the worst hit sectors. So thank you very much, everyone, and I hope to see you on the next session.